It's widely known that cars used to be depreciating assets. The moment you drove them off the lot, they'd lose a significant amount of value, and this decline would continue over time, measured as the residual value. This made sense because unlike stocks, bonds, or land, cars are assets with an unlimited supply that eventually wear out and go out of style. But after the unusual events of 2020, the car market did something unexpected. Used cars began to appreciate in value, causing prices to skyrocket across the market to levels that were once unimaginable. The car bubble had grown to a point where everyone believed it would implode, and right now there are signs that maybe this prediction has some merit. But before we dive into the current situation, let's take a step back quickly and examine some recent history. The Manheim Used Car Index, which tracks wholesale prices nationwide, surged to 257.7 in January 2022. This marked a 67% increase from the level just 2 years earlier in 2020. It was clear to everyone that this rapid growth couldn't last, and after new car manufacturers resumed production, these wholesale prices began to stabilize. As shown in the chart, wholesale prices have been consistently declining since 2022 and are now down about 23%, with another 21% needed to reach pre-2020 levels. In essence, it could be said that the wholesale price is crashing, pushed down by rising new car inventories, high rates, and high insurance. Just from last month alone, the seasonally adjusted month-over-month change was 2.3%. This has made experts turn their heads and ask if this is the start of a meltdown in the used car market. If you listen to the YouTubers, Twitter personalities, and journalists, you will see that a lot of them do believe that bad times are coming. But if you're out there shopping for a car, you might see a different reality, one that doesn't follow this chart or the reports. For example, if you're in the market for something like a Toyota Camry, what you'll see is that prices are still outrageous when compared to the pre-2020 world. According to car gurus, the typical price of a used Camry was around $16,000 in 2020. Shortly after that, we saw the explosion in prices that followed the rest of the industry, and by September of 2022, the price had gone up around 40%, peaking out at $23,000. Now, from that point, we did see a slowdown, but nothing that would make a consumer happy. Right now, a used Camry will set you back around $20,000, which is only about $3,000 from the peak, and when we include interest rate expenses, it could be argued that from the consumer point of view, it was actually cheaper to buy up here from the perspective of monthly payments. Of course, this wouldn't apply if you're a cash buyer, but regardless, it's clear that with some brands, the slowdown we have seen in the Manheim Index hasn't really translated to cheaper retail prices, especially when you adjust for the massive move up in interest rates since 2022. However, it's pretty clear that certain sectors and brands are in fact in the middle of a massive crash. Looking at the price of something like the Mercedes-Benz C-Class, you get results that look like a different world when compared to what I just showed with Toyotas. These starter luxury brand models have taken a massive hit following the collapse of stimulus money and higher rates. According to car gurus, if you had bought a 2020 C-Class in November of 2020, it would have cost you around $44,000. By the end of 2021, that same used car was now worth $53,000, meaning it had magically become an appreciating asset. Your used Benz was now gaining value as you drove it. But since that peak, this same car has undergone a complete collapse, with its value falling by 40%. These used starter luxury models, especially those 2020, 2021, and 2022 model years, have taken a serious beating across the board, and it can be said that this portion of the used car market is in the middle of a crash. You can hear Lucky Lopez explain this in his most recent upload. If you want to listen to the full video, the link is in the description.
Now the next two obviously are luxury SUVs and cars. The reason why I think this segment got so hit and why it's going down so fast is this is one of the fastest rising sectors with so much people just going nuts because they had all this extra money. How many people you know that were broke that are driving a Mercedes, a Cadillac, a Lexus, an Audi? I met so many people that were buying these things. I remember the guy at 7-Eleven at the gas station I go visit every time bought an $85,000 Genesis. I can't remember the name of it. It's the SUV, the luxury SUV. You know, he should have never bought that car, but now that car is probably worth 50% of what he bought it for. So as this inflated market got nuts, banks started realizing that, you know, the market wasn't there, so they stopped lending on these cars. Once the banks kind of pulled the strings and said, you know what, we're not going to give you 150, 160% LTV, they started walking it back. They'd rather have regular cars that are going to last longer with less maintenance. So what did this do? This impacted the market where now you can't buy some of these crazy SUVs and luxury cars for top top dollar. They're starting to wind them down. Most Americans don't have the massive down payments that banks are going to require when it comes to these types of luxury cars. I've noticed that companies like Westlake, Ally Finance, a few of these other ones don't want to do those cars unless you have a big down payment.
So the summary is that depending on the brand, model, and year, the used car market looks very different from case to case. Overall, the market is clearly in a decline, and in certain spots, it's definitely in a crash. So where is it headed in the future? Well, to understand this, you have to quickly understand one simple thing about the economics of the car industry. At the end of the day, it all comes down to supply and demand. In the case of used cars, the whole market is driven by the new car supply starting at the top. If new cars are cheap and plentiful, you can bet that used car prices will fall. In the early 2020s, we know that manufacturing took a hit and the supply of new cars dwindled. This caused dealerships to do things like market adjustments, which were essentially massive premiums people were paying above sticker prices. This made used pretty attractive, and of course, prices spiked in a way that we had never seen before. Now, US production is almost at its pre-pandemic levels, lagging only 5% from its 2019 average. This has caused a switch. On top of this, right now for used vehicles, if you're a prime buyer, your interest rate is likely pushing 10%. And if you're a subprime buyer, it's around 19%. This means pressure from the new car market is flowing into the used, and we're seeing prices decline across the board. When you turn and look into a proper dealership lot and you see the lot full, that's a sign that used will become cheaper. Brandon from the channel CQA Live, he recently went to a Ford dealership and described the situation he was seeing. You can take a look at this clip to get the full picture, and just like before, the full video is in the description below. But as you will see, things are starting to change. Take a look.
This truck is $98,000. It's the Black Widow package. It's lifted. It's nice, but crazy, crazy, crazy number. And guess what? They got a whole row of them. So I'm at a Ford dealership today. I'm going to walk this whole lot. I'm going to show you what Ford's offerings are here at this dealership. I'm going to show you what they're listing for, the crazy prices you're going to see. And I'm going to go through this whole entire lot and take you with me. So we're going to start right here. See, there's a whole line of Ford Mustangs. I haven't seen a whole lot of these at these dealerships. Here we go. This one is a 2024 GT Coupe Premium, and they're selling it for $53,000. The reason why I wanted to come to this dealership in particular, I've been here a lot of times, and I've picked on them quite a bit. But what I have noticed is that they have moved with the market. And what do I say about that? About a year ago, I came here and they didn't have a ton of inventory. But what they had a lot of market adjustments, add-ons, stuff like that, things that I don't like. You know what, I can get with it. I understand it from the standpoint of the business side. Last year they didn't have to, but in the short term it made sense for them to add market adjustments. But as we go forward, as I've been to this dealership quite a few times, I've seen as the market has gone down, I've seen market adjustments come off. I've seen that some of the add-ons have come off. And that's what I want to do here today, is go through this dealership, see what they're doing, see if they're continuing to move with the market. My anticipation would be that they are. And I'm hoping to see some discounts around here somewhere, because that would tell me that, okay, I see that we have a full dealership. This is the fullest that I have seen this dealership since I've been coming to this dealership to check on Ford prices.
Okay, so as you just heard there, it is true that new car supply is up, which like I mentioned before, means that pressure in the used market will fall off, as it's been doing. But there is one aspect that is left preventing used prices from returning to the pre-2020 standards, and it's talked about in niche industry papers. It's the last remaining piece in the supply-demand picture, and it's called the lease cliff. Lease returns are a significant part of the vehicle supply, and they are still limited. Before the pandemic, many people who lease cars would return them, creating a steady supply of used vehicles. But during the pandemic, instead of returning their lease cars, people chose to buy them outright because they could get them at a good price. As prices have dropped, leasing companies are now cautious, trying to avoid having too many returned cars. If one brand's prices falls too quickly, the leasing companies might end up with too many of those cars, pushing their prices down even further. There's a whole Moody's article about this that we'll probably dive into in a different video, but essentially because so few people went with leases or straight up bought them out in the last few years, the number of incoming cars that are expected in the next few years is very small compared to historical averages. This means that the used market actually can only move down so much because this part of the overall supply is still strained. Until this multi-year lease cycle flows out, we actually might not see prices collapse as severe as some people claim. I'll dive into this topic in a future upload, but in summary, yes, used prices are down and they will continue to be challenged, but because of this lease cliff, it may not be the crash everyone was expecting. Thank you guys for watching. As always, please make sure you hit that like and subscribe button if you enjoyed it, and let me know in the comments below what you're seeing in your used car market.